Hi, I'm Steve Clapham. Welcome to the Behind the Balance Sheet podcast, where we meet leading investors and commentators and educate ourselves about the world of investing and the world at large. Our mission is to remove some of the mystique around investing and improve our understanding of what makes a successful investment or indeed an unsuccessful one. Our goal is to inform, educate, and entertain. We hope you enjoy this and every episode.
Behind the Balance Sheet and affiliates and podcast guests may own shares or have an economic interest in securities discussed in this podcast, which is aired for your education and entertainment only. Nothing in this podcast should be construed as investment advice or relied upon for investment decisions. Always do your own research.
Tom Slater has been with Baillie Gifford for his entire career, some 25 years, and now runs their US equity team and manages the Scottish Mortgage Investment Trust, the largest such vehicle in the UK with a 10 billion sterling market cap. Tom runs a growth strategy, and I was keen to have him on the podcast for two reasons. First, to understand what growth managers do differently from traditional value managers, which is how most of my investor guests have described themselves. And second, to explore what has made Baillie Gifford such a successful institution. It runs roughly $300 billion, is based in Edinburgh, and was founded in 1908. It's one of my clients for both training and research, and I have observed their culture at close quarters, and I find it rather intriguing. Tom didn't disappoint with his explanation of how he remains calm in the roller coaster rides of many of his stocks. Nvidia, for example, had a 63% drawdown as recently as 2022, on its way to that $3 trillion capitalisation. What makes the Baillie Gifford culture so special? Why Tom favours technical founders, and how that affords their companies a real advantage in the age of AI. What Elon Musk said to him in 2013, the difference between investing in publicly quoted companies and those in private markets, and why, in their process, they don't pitch stocks to the team, which he believes gives them an important behavioural advantage. Tom may run two massive investment strategies and have made fortunes for his clients in backing the world's most successful entrepreneurs early on. Bezos in 2004, Musk in 2013, and Jensen in 2016. But Tom is incredibly humble, down to earth, and able to laugh at himself. Apologies, we had some technical issues in the studio which caused occasional interference, which even Neil, my wonderful sound editor, might not be able to remove entirely. But it won't be as bad as the Hoover in episode 1. Here then is my conversation with Tom Slater. Tom Slater, welcome to the podcast. I'm excited to talk to you, and I always start with the same question. You studied maths and computer science, but did you always want to be an investor, or was it just chance?
It was chance. I didn't know what I wanted to do. I'd taken some summer jobs doing computer programming, and then I had a friend from maths, and she worked in the city as an intern, and also was dating a guy from Baillie Gifford.
Oh, right.
And it was the combination of those two things put me onto the idea.
And what attracted you to investing? What was it?
I think it started with an interest in companies and what makes them work and why some are successful and why others aren't. And it was more that, I think, than interest in the stock market.
Yeah.
Per se, it was, and I guess this this idea that you couldn't, it was a craft that you couldn't master effectively.
Yeah.
That you could, if you stick with computer coding, there's the toolkit is really important, and that and you can. And obviously you can continue to increase your skills, but there is a certain extent to which you can become a master computer programmer. But investment is all, just when you think you've got it, you will be proven completely wrong. So,
and the computer programming, does that play a big part in the way you approach stocks? I mean, because when you have a conversation with a tech founder? Are you able to go a lot deeper than most investors?
I struggle with this one because I think a little bit of knowledge can be really quite dangerous.
Right, yeah.
These people that are at the cutting edge, thinking you actually understand what you're doing what they're doing is quite dangerous. So I think that it's brought I think it's probably brought something of a mindset to investing. There's a book a few years ago called Thinking in Algorithms. I can't remember who wrote it, but I guess that there is something about the mindset of the way one approaches programming computers, which has a relevance. And then I do think there's an affinity or comfort with tech companies, which coming from that background. But do I understand better than you do how Google's algorithm works? No, definitely not.
Do you still program? Or are you completely?
No.
It's funny because I've got this online training school, and particularly in COVID, I used to get a lot of computer programmers signing up. It's how to learn to invest, and of course they all thought they were geniuses, and then they found out they got confused between the genius and the bull market. So listen, you run the US team, you manage Scottish Mortgage, which I guess is the biggest investment trust in the UK and probably one of the biggest in the world, I guess. Funds.
I think biggest conventional investment trust, 3i, I think is bigger.
Oh yeah, of course, yeah. But 3i, I wouldn't classify as the same. But you began managing it under James Anderson, the former senior partner of Baillie Gifford, back in 2009. In fact, you've worked in Baillie Gifford all your career, which is quite interesting. And you became co-manager in 2015. You took over from James in 2022. I wonder what changed at these points. And I suspect you're going to say, oh, not much changed. But being in charge is probably different, right? It must be different. It must mean more worry, more sleepless nights. Or do you not have sleepless nights?
Well, I don't think, as you suggest in the question, I don't think there were these big transitions. The trust had a very difficult year in 2008 with the financial crisis, and it was then that I joined the management with James. I guess providing some support, which was quite a difficult time. We obviously in that instance rebounded pretty quickly in 2009. And then, we obviously worked together. And the way, I think what's relevant here is the way that we worked together, which was, we basically would back each other's judgment.
Right.
And, where we had stocks or investment ideas that we were enthusiastic about, they would go into the portfolio. And I would tie that partly to the philosophy about this is about finding winners and running them for long periods of time. So it wasn't that we would, have long debates on stocks and try to come to a view. It may sound odd, when he was obviously at that point in 2009 far more experienced investor than me.
Sure, yeah.
But it was, it was about putting those ideas in together. And then I get over the next 6 years, I guess it's learning the investment trust industry, which is, has its own idiosyncrasies. And then James went on sabbatical in 2014, I think, and then post that we moved to a co-manager structure. And then to your point about, is there a set of stresses that come? Lawrence Burns obviously joined as the deputy manager in 22, maybe earlier, but and so he and I now manage the trust together, and I don't think there's much distinction, but there really in from a stocks picking standpoint on the deputy co-manager thing, it's all just titles, but I think the stresses of the past couple of years have less to do with that than just a very difficult market, a tough performance period for us in the aftermath of COVID, particularly in 2022.
Sure.
And dealing with those issues.
And how do you manage it? I mean, you in the US team, I know you have this idea that you don't pitch stocks which I think is really, really interesting, because you think that it creates certain behavioural biases, and you think they're advantages. Just talk us through why that is, and do you do the same with Scottish Mortgage?
Yes, I mean it's captured in that same idea that of backing enthusiasm, and I think of it this way. So let's imagine that you and I were managing the portfolio, and we had to agree when we bought a stock. And I have an idea, and with any stock idea, you're not going to have 100% conviction. Sure. You're going to have some things you're enthusiastic about and some doubts. But if we come together to discuss this stock, and if the outcome is, if I want to buy the stock, I need to persuade you, then that's going to naturally lead to some behavioral consequences. I'm going to overstate the positives of the investment case. I'm going to, whether deliberately or not, I'm going to de-emphasize the negatives, because I've made up my mind what I want to do already.
Sure.
And maybe I convince you, and maybe we buy the stock. Then the next behavioral trait you run into is this pressure to be consistent. The people, as humans, we value people who are consistent, who don't change their mind a lot. Now, if I've if I've gone in all positive on the stock and emphasized the positives and we've bought it, it's very hard for me to turn around and say, actually, no, I think we should sell it.
Yeah.
So maybe best sort of captured through an example. I don't know. Let's take Meta, the owners of Facebook. If I come in and say to you, I think we should buy Meta. It's got all these fantastic opportunities in AI and X, Y, Z. We really should buy it. It's really cheap. Let's do it. And you say, yeah, okay. Contrast that with if I come along and I know when we start the conversation that if I want to buy it, we're going to buy it. That's not up for debate. So what we're trying to do is have a discussion of the investment case. And I say, well, what I like about Meta is that you've got these really great under-monetized assets in WhatsApp and Messenger, and I think AI can lead to this really big positive. On the other hand, I'm a bit concerned about the Blue Top app because it seems to be well behind TikTok in terms of the curation algorithm, and there could be developments there which would undermine the case. Then we've had a frank discussion of the pros and cons, and then if a week, a month, to a year later, I come back and say, look, actually, some of those concerns about the Blue Top app were right. I think we should sell, and it's just much easier for me to have that conversation with you, and so I think having that sort of mechanism, let's back enthusiasm, it relies on a couple of things. I think it relies on everybody being committed to a clear philosophy. It's no good me coming up with my high growth idea and you coming up with your deep value idea and saying, how do we put those together? And we've got to back each other so they go in the same. You've got to have a commitment to a shared philosophy. Yeah. And then I think you've got to have trust in the other people that are doing it, because we know we'll get things wrong. But it's saying, well, actually, over time, on average, I trust this person's judgment, and I may disagree with them, but I've got enough evidence to suggest that it's worth backing them.
Do you think that would work in a value fund? Because this works because you're worrying about your big winners, and you're prepared to tolerate a lot of losers. Would it work in a more conventional fund, do you think? Might be more difficult, I suspect.
Yeah. To my mind, it's not something that is connected to growth or value. But if you hit on an important point, if you look at the structure of our delivered returns, it's not about being right more often than we're wrong. Yeah. It's how much we make when we're right and how much we lose when we're wrong that matters to us. But I think if you have a different structure of returns, I think some of those behavioral characteristics still apply. If we're debating a valuation case, again, does it help for me to be trying to sell you on the idea?
No,
if you trust me as an investor, and I know I can make the final call, then actually I'm probably more likely to listen to your concerns about it. Have you considered that? Is there some aspect of the case which actually you weight more heavily than me, then once we've got away from this dynamic of trying to persuade, then actually I'm probably going to be more receptive to your ideas on it. And
does the agreement or disagreement, would that colour the sizing of the position?
Yes, I think there's for me there's two variables. One is how much agreement is there on it?
Yeah.
And the other would be how strongly does the proponent feel about it? So if I feel very strongly about an idea or transaction that we should do, then even if you disagree, I think you still have to take that into account. Whereas if I'm just over the line on an idea and I get everybody else just over the line, again, it's always a matter of degrees. It's not binary.
And this philosophy, this approach, this process, it results in fewer ideas, do you think? Because you only bring your higher conviction ideas, but you know they're going in the fund. Or do you think...
I think that is probably... I think it probably leads to more self-censorship. So again, go back to that, you're having a group discussion. I've been doing the work on a stock for the past month, and I quite like it. It's got its merits, but, probably the outcome of that is I bring it to the group and say, I think it's a buy, and allow myself to be talked out of it. But I want to show everybody I've done the work. And whereas if I bring it to that group and I know that if I want to buy it, we will buy it, then I'm probably not going to bring those ideas that I don't feel as strongly about.
So do you end up with a sort of repository of things that you quite like, but they just aren't the right price? Or
yes, I think it just, and I see this as a positive, but when you come together to have a stock discussion, you want it to mean something. I don't. This is a good idea that somebody's put some work into, so let's give it some airtime. That, I can understand the dynamics that lead to that discussion, but I don't think it's a very productive use of time. So I'd rather people killed things higher up in the funnel of their work, and only, I do think it's things that people feel strongly about where you can have the most valuable conversations.
No, absolutely. And it must be different if you're running a growth fund, because you're looking for those big opportunities, those big winners.
I slightly struggle to answer the question because I've never run a value fund.
No, sure. But you've done like UK equities.
Yes, yep, I have. And I think, if for me actually that point about big winners is partly and it partly is our our style at Baillie Gifford at Scottish Mortgage is growth, but actually I think a large part of it is actually about time horizon. Because if we're all taught that stock market returns are normally distributed and outcome of stocks are normally distributed, but actually if you extend the time horizon to 10 years, you get this log normal distribution. You get these outliers, and there's nothing then that says those outliers have to be growth stocks, and indeed some are, some aren't. So I don't see that it is a growth versus value thing. It's a time horizon thing. And I think if you identify attractive opportunities, underpriced opportunities, then they can pay off many, many, many times over a 10-year time frame.
But what sort of things that wouldn't be growth stocks? Would it be like serial acquirers, or what sort of category would be in that stream? I should know the answer to this because I have interviewed Chris Mayer, who wrote 100 Baggers, and there was a very wide universe of stocks. But let me put the question another way. So do you go fishing in other waters other than the growth waters?
So I don't, because I think that one of the things that's really important about a fund or strategy is having identity.
Yeah.
And that your clients, that your investors have a clear reason why they want to own you. They understand what you do, and then they can make the allocation decision for themselves.
Mm-hmm.
And you can in a way you can think of it as sort of circles of competence, right? The sort of classic Buffettism that his circle of competence is much wider than that of the rest of us. But I think it's really important that you have an understanding of what you think you can do and you stick to doing that. But I think that if one of the there was an academic piece of work that looked at concentration of the US stock market over the past 90 years. And it showed this ridiculously small number of stocks, 90 stocks, had contributed to half of the excess return in US equities over 90 years. But the one that sticks out to me from that list would be General Motors. Now that you wouldn't say that was a growth stock, and indeed it went bust. Yeah. But actually, if you looked at over that 90-year time frame with the growth it achieved plus the dividend payouts, made it one of the 90. So I don't, I think if you can get an underappreciated long-term compounder, it absolutely can be one of those,
Sure.
manifold return companies.
Sure. And just, I was wondering, you mentioned about an investment trust earlier. Is there, any difference in approach when you've got permanent capital versus, say, a retail fund with daily liquidity versus an institutional fund? Is there any difference in the way you manage those?
I think that the differences are subtle but important. The killer one from a returns perspective is the flows. Because we all know that the people will tend to allocate and take away capital at the wrong time based on historic performance. And I think what it does mean is that you're not forced to sell or reduce stocks at the wrong point in the cycle. I think another important part of it is the relationship that you can have with companies because you do have permanent capital.
Oh, really? Okay.
Just because you can have a time frame which is more aligned with theirs, and that's important in public markets. It's even more important in private companies because the typical structure there is a 10-year limited life fund, which means 3 years of deploying capital, 3 years of being a shareholder, and 3 years of trying to sell stuff. And so, if you sit down and say, well, I've got permanent capital, I don't really care when you list, as long as you're actually making operational progress. And I think that's a different conversation. So there's certainly advantages to it. And, on the flip side, there are challenges as well with discounts and so forth.
So Baillie Gifford is an important client for Behind the Balance Sheet. And I always enjoy my trips up to Edinburgh, because you've got a very different culture. The young people are always encouraged to speak up. There's always a lot of debate. I always find it very challenging, actually. When I do a training course there, it's always good fun. But I just wondered, you've been there like 25 years, I think. How's the culture developed over that? And how does the culture give you an investment advantage?
Well, I think, first of all, thank you for all that you do in terms of helping our investors get better at their jobs. I think start by just we try to think a lot about culture when we're investing in companies, and we've tried very hard to get better at that. And if I do the sort of extremes of it, if I can look back at meeting notes from company meetings from 15 years ago or something, and people will write "good meeting." This was a good meeting. And what does that mean? Does that mean you got on well with the management? Did you had a good chat? But it's trying to get away from that, and so one of the simplest frameworks that you might look at a company culture on would be, say, right, there's two axes. One is the culture weak or is it strong? And it sits somewhere on that spectrum. And then on the other axis, you might say, is it aligned or not aligned with what the company's trying to do? So take Salesforce.com as an example. you meet the people from Salesforce, and they're extremely hard driving, promotional. They have a certain way of speaking, and I don't personally feel very comfortable with it. But equally, you'd say it's really identifiable. It's a really strong culture, and it's really aligned with what they're trying to do. So that's a very simple way into that discussion on culture. But so take that back to Baillie Gifford. I think we do have a strong culture, and I think part of that is the focus on, particularly on the investment side of the business and recruiting graduates. Yes, I started 25 years ago as a graduate, but I'm not unusual in a Baillie Gifford context for having done that. In fact, that's the norm. So what I think that leads to a strong culture, because I see it in a lot of other firms, because investors move between firms, they take a bit of that culture with them, and so you get it tends to have a mean reversion element to it, whereas because you're getting relatively few people later in the career, it doesn't. So you, and then I think the next ingredient would be that we very deliberately try to recruit people with a mix of academic backgrounds. And so it's not, your first question was around, did I always want to be an investor? We want to have some of those people who always wanted to be an investor, and people who've, one of the big efforts in our graduate recruitment is actually trying to find people who hadn't even considered the investment industry as a possibility. Students from arts backgrounds, for example. So we put a lot of work into that. So you want to bring in people with a diversity of academic backgrounds and interests, and then you can give them the tools to think about investments. So I think that's another piece of it. So I do think you have a strong culture, and then it's and the reason for bringing that breadth in and those different perspectives is trying to align it with our way of investing, which is to be very long term. You don't want people with a telephone in each hand and 12 screens in front of them, yelling into the phone. If you come to the office, it's a bit more like a library. You're encouraging people. It's a perfectly acceptable part of doing your job that you would turn up to your desk and open a book in the morning and read. That you find an area you're interested in and excited about, go off and work on it for the next 2 or 3 months. Identify who the important players are, who the academics that you could learn from. Go spend time with them. And so I think it's some of those ingredients that lead to something that's a strong culture that's aligned with what we're trying to do.
But it hasn't really changed that much from what you're saying. Obviously, the technology's changed, but the way you do it, but the philosophy hasn't changed much.
I think that what I would say that there are some pillars of that process which are unchanging, but actually, if you look at where the firm has had success, there has been this constant process of change. You mentioned I worked in our UK team earlier in my career, and in the 2000s, our UK equity desk was the biggest desk in the firm. We had some nascent international businesses, but our investment process evolved. We had success with international strategies for US clients, emerging markets as it became, then global strategies. So actually, the evolution of the type of strategies we were offering, generally, the performance requirements became higher, portfolios became more concentrated. The mix of the client base transitioned from UK to global. So I would say that one of the constants has been change, and actually adaptability would be one of the pillars.
Right, interesting.
And at the same time, I think the investment process has moved on a lot. I think we were, there was a lot of, if you go back to the early 2000s, a lot of focus on tracking error and volatility controls, and again, actually challenging some of that orthodoxy and doing things differently.
Yeah.
was a really important part of that transition.
Yeah.
So I think some of the ingredients are unchanged, but actually change has been and actually being prepared to be adaptable has been a really important component of the culture.
Well, I hope you're enjoying this episode, and if so, you're bound to enjoy our free newsletter on Substack. It's a weekly email I send out each Sunday morning on interesting investing-related topics. Just visit behindthebalancesheet.com and hit that little sign up button on the top right. And while you're there, you should check out our fabulous online investor training school. Hundreds of students have taken our flagship Analyst Academy course, which teaches you everything you need to become a serious equity investor. And if you're a professional investor, we also run a forensic accounting course for institutional clients and a cohort-based course for smaller funds and for serious amateurs. Email me at info@behindthebalancesheet.com for more information. It's interesting. You've been very successful. You talked quite a bit about being long-term, and the fund turnover at Scottish Mortgage picked up a bit recently, and I think it's picked up to 15 or 20% this year. And I'm always puzzled. People talk about, oh, you should be long-term, you should have low portfolio turnover. I always think that's funny because the world changes, and you make mistakes, and you don't want to be discouraged from taking action on a mistake because you're worried about your turnover. It seems like it's a residual to me. Do you have a view on that? And is the growth strategy, does that force you to have a longer term mindset?
So one of the things that has been important for us in investing for Scottish Mortgage is trying to learn from the brilliant people that run some of the companies that we've invested in. I think also, I'd link that. So just because people look at the track records of investors and try to think what they can learn from other investors, but actually, if I look at, for example, at the management of Tencent, Tencent have probably been some of the best investors in the world. If you look at the past 10 or 15 years, these people don't necessarily sit in the classic structures that we might look for great investors in. But probably more than anyone else, the person that we've learned from over the past 20 years has been Jeff Bezos. And I remember sitting in a room with him in Seattle, and there was a group of his long-term shareholders, and somebody asked him, as you look out over the next 10 years, Jeff, what do you think the biggest changes are going to be? And he said, well, I'll come to that, but actually you're thinking about it the wrong way round. What you need to think about is what will still be the same in 10 years. And, I know that 10 years from now, people will still love low prices. They will still want convenient delivery. And so I think that framework is important. So I think when you go to your question, low turnover, I think is, because you're looking at companies that you think there's something about the culture, there's something about the way that they approach the task, there's something about their adaptability and flexibility that means that if you haven't identified enduring advantages, that they should be able to survive that transition in circumstances, and that should drive low turnover. But I agree with you that low turnover should be the output, and it's not no turnover. We're not stick with things forever, but also it should vary, because there should be times when if you have a stock that's done extremely well, then you need to. One of the ways we've been successful is finding those stocks that have done really well and continuing to hang on to them as they've continue to do really well. But in order to do that, you have to be asking the question, what is the upside from here? Yes, it's done well. Yes, I've made money, but what is the upside from here? And when that question becomes more challenging, it should drive turnover. You should be selling.
And do you have sort of fixed risk limits because the problem, I mean, it's a nice problem to have with running your winners, is you end up with very concentrated portfolios. And how do you overcome that challenge?
So in Scottish Mortgage, we have the constraint written into the investment objective is that we will put no more than 8% of the portfolio into a stock at the time of purchase. The tool that the board monitor is the equivalent number of holdings. So it basically says, if you take an 80 stock, the 80 or 90 actual holdings that we have today, what does that look like as an equally weighted portfolio? How many stocks would it have? So you try to adjust for the concentration in the positions. So to explain that in really simple terms, if you had a 2-stock portfolio and you had 50% of the portfolio in each, then your effective number of holdings is 2. If you had 99.9 in one stock and 0.1 in the other, then your effective number of holdings is 1. And so they look at the effective holdings, so they adjust for that skew in the portfolio, and there's both a hard minimum on that, and then a rule of thumb that we manage the portfolio to.
And is it uncomfortable trimming those winners?
It is. Well, let me answer this 2 ways. As a fallible human, it's really not uncomfortable trimming those. That's what you instinctively want to do. This stock's done well. It's now 10% of the portfolio. It's volatile. If it halves, there's this strong intrinsic motivation to trim those winners. I think the discomfort comes from the fact that we know, let's say 5 stocks are responsible for all our returns in the past 10 years. And anything that we've done to interrupt the compounding of those 5, would have meaningfully impacted our returns. And so I'd say it's not an uncomfortable feeling, but it's it's just that knowledge that you need to be pretty careful and pretty sure when you start to interrupt that process.
Because you sold down Nvidia this year.
Yes. So Nvidia we bought in 2016. So it's been a long-term holding. At the time when we bought it, what we liked about it was we saw the potential for this technology, and in 3 different areas. One was AI and data centers. One was around machine vision, and the other was around sort of self-driving autonomous vehicles. And it's hard to put the odds on any one of those 3 succeeding, but what we liked about it is that you had these 3 really big options. And we didn't know when, we didn't know if, but that's what's driven the return since, and certainly very recently. So that it's been a very successful investment for us. It has that common characteristic of most of our successful investments, that it's been a very uncomfortable ride. So it's done well recently. Aren't we clever? Well, its biggest peak to trough decline in that period of ownership was over 70%. I think it was 73%, as recently as 2022.
Yeah.
So it inflicted a great deal of pain on us. But I think it's back to what we were talking about earlier. You've got to be testing the upside. How much do you think you can make now? And for us, from where we are today, $3.5 trillion of market cap, that maths gets harder and harder.
Sure.
So you combine that with thinking about the fundamentals, and I don't think we want to get into details of AI at this point, although we can if you want. But we think management have done a great job. We think the company has some formidable competitive advantages, but it's just having that discipline around upside from here. And then the final point to make on it is just being just accepting that there's a lot that you don't know. we're not certain that the upside, but there's a lot of fuzziness around this. But for us, there was enough there to be. For Scottish Mortgage, we sold £1 billion of stock in 2024, so a pretty substantial call for us.
Well, you've also been a long-time backer of Tesla, and I think you bought Tesla in the IPO, right? I think.
No, we bought it. I think it's the start of 2013.
All right. Okay. And you're still a holder of Tesla and of SpaceX. Musk is in the news sort of every day. He's now going to have a much wider role with the oddly named DOGE. I wonder, do you have any observations about him that you're happy to share? Because it seems to me, it must be peak Elon when I read in the FT that the Chinese government is consulting him on what they should do with TikTok, and when he's, making mad comments about our prime minister. How does that, and any anecdotes, any observations, and how does it affect you when you're looking at the investments? Because you must worry. There's only so many hours in the day, and he might be an incredible genius, but he's got a bit too many toys, right?
Well, one of the things that I think is important when you're listening to what people are telling you is trying to assess how credible what they have to say is. And I think with Elon, if I go right back to when I first met him in 2013, the history of it is, I think from memory, I think we started buying the stock towards the end of 2012, and it's had a share split since then, but it was about $30, and in the space of the time we were buying it, it went to $100. So we hadn't bought all the stock that we wanted to do, and we were sitting there thinking, well, what do we do next? And so I went, and he wasn't the celebrity then that he is today. It was possible to go out in California and see him, and I was asking him, you've had success with the Model S, but when the German manufacturers are going to do this, and they they've got all this manufacturing expertise and et cetera, et cetera. And so I've asked him these sort of questions for 5 minutes or something, and he stopped me and said, listen, you just don't get it. He said, our ability to succeed will be dependent on our own execution. They are institutionally incapable of competing with us, and he wasn't. He was saying that out of the experience of building the prototype electric A-Class for Mercedes, for example. It wasn't just taking a sideswipe at them, although it was partly that. And of course he was spot on. The highs and the lows of Tesla of this intervening period have been entirely driven by its own execution. But you sort of wind the clock forward through all of those the ups and downs of the past 10 years with it. What he's achieved in the world of business has been phenomenal. It's created huge amounts of value for his shareholders, and therefore go back to this credibility thing. When he says something, you've got to he has a very high credibility in saying it. And there's been times when he said things to me in the past, and I thought that's absolutely nuts. But then I remind myself it would be nuts if the person off the street said it to me, but actually, right, remember who it is that said it to you and what they have achieved. And so I think that's really an important lens to consider when he's speaking. I think that the issue you mentioned, the issue of bandwidth, and again that's been a persistent concern. But go right back to that that first meeting. So I was sitting with the CFO of Tesla at the time, Deepak Ahuja, and he was saying, we were talking about what's like working at Tesla, and he said, well, I'll be answering Elon's emails at midnight, and I'll go to bed. I'll wake up at 5, and I've got 6 more in my inbox. And he's incredibly focused on work. Even as he added, because he was doing SpaceX and Tesla at the time, but then there was the Boring Company, there was Neuralink, then there was X. It's one of these perennial questions, the breadth here. But I think what the question that follows from that is who is around him. You can that he's always in the spotlight, but then actually what's the team like that's supporting him? And again, I think you can see that in Tesla when if you go back to production hell in 2018, that team around them was not sufficiently strong actually to focus on the bits that he was less good at or focused on. And then the subsequent years of execution, with the launch of the Model Y, with the internationalization of the business, the factory in Berlin, the factory in China, all of those ramp-ups have really gone without the same sort of hiccups. And it speaks to he's in the spotlight, but you need to look at the other pieces as well.
No, I believe that they're recruiting like mad for the new department and recruiting some really amazing people who are excited about the opportunity to serve. So I guess we shouldn't dismiss his claims. When he made those mad claims about, or when he was setting his remuneration package, which was suddenly thrown out, and I remember thinking at the time that's like bizarre. And of course you would support that because the chances of him achieving that are very low. And if he does achieve it, I'm going to be really rich. But I was thinking, God, that's bizarre. Did you then go and say, oh, crikey, well, Elon said this, he's probably going to do it, and we better buy some more stock? What did you think?
Well, we voted in favor of that remuneration package. The Tesla board gets a lot of flack, but they had a process for looking at it. They came and consulted us as substantial shareholders before they went ahead with it. So, the quantum is obviously a hugely controversial topic, but the lens that we looked at it through was, to achieve this, our shareholders, our clients as shareholders will make an extraordinarily large amount of money. And I think it's I think that's there's so much controversy around it, but you go back to creating value for shareholders as the fundamental building block, and that's not to say everything that he's said has come true, but I do think that you can. It's neatly summarized in, I think, a line that he used himself, which is that he's turned the impossible into the merely late.
I love that. Now, Baillie Gifford has got a very good magazine, which people should read. It's called Trust, I think. And you wrote an article in it in the last edition about founders, managers who can get their hands dirty, and you wrote about Zuckerberg. Can you just explain the rationale that you outlined?
So I can't remember. So I did one about founders, and then I did one about technical CEOs.
Technical ability. So he programmed his doorbell or something.
Well, what I was getting at with that, and so there's a slight, a nuanced distinction, right? But the point I was making there was that technical CEOs were in a particularly strongly placed as you think about what's coming, because it seems to me that AI is a hugely impactful technology transition, which is going to play out over the next 20 years. And if you sit in a big corporate, you're looking at this saying, yeah, I think AI is important. So you've probably got a few of the guys from your tech team playing with the technology, some sort of skunkworks, and you probably think it's a bit more important than that. So you've got some consultants in who are, charging you some pretty high fees to come out. They're saying, right, well, what's the first use case, and maybe you can put this in your call center or something. And it's going to take them 10 years, and it's going to cost them loads of money to implement. And by the way, all of their competitors and peers are going to be doing the same thing. And so, net, probably you have a more efficient business at the end of it, but you haven't gained any edge. But the technical founders, are on top of this technology in a really deep way, and then are driving it through their business today. ChatGPT, Daniel Ek from Spotify showed me that months before the thing went, but he's, and not only did he show me it, but he had this is going to completely change our business. And and so you don't have different levels of the organization trying to work out what to do and getting you have and the thing about you could go to technical founders, well, they can drive change through the business in a very short space of time. And so so when you look at if you take the example of Zuckerberg and Meta, he doesn't need anybody to tell him what the potential of AI is, and actually that played out in a really tangible way. So if you go back to 22, that was the era of headcount. We were in the post-COVID period, growth had slowed. The whole tech sector was cutting back on spending. Capital had a cost again. And one of the consequences of that was big profit warnings at Nvidia. You saw all these Nvidia chips sat in warehouses unused. And it was that point in that environment that Zuckerberg went out and placed a huge order for Nvidia GPUs, because he could see what was going on in AI and its impact. And so, forget the stock market, 12 or 18 months later, waking up to the fact that Nvidia was going to see the surge, and everybody else scrambling to get chips. Well, he'd got them back in the dark days of 22, because he was a technical founder, because he could see what was coming, because he could connect that to revenue opportunities in the business. And I just think that's such a valuable input to your decision making in the environment we're in today.
Absolutely. And presumably you're better able than most to connect those dots when you see that happening.
Able is an interesting way to describe it, because I think we work in the finance industry. There are so many seriously smart, seriously well-paid people who are highly motivated to do this. So I don't think differentiating yourself on ability is possible. And going further, I meet investors all the time who are much smarter than I am. So I think instead it's how can you set yourself up to see these things coming, and for us, actually, I would link it all back to time horizon. We're trying to invest over 10 years. If you're investing over 10 years, the relationship that you can have with a company is different. It's you don't want. How many analyst quarterly calls do you sit on where they say, ask a question about the quarter, and then they follow it up with a question about the 3 weeks since the quarter end. Can you give me color on what's happened there? Did you exit the quarter faster than the run rate? But actually sit down and say, right, where, as you think about the next 10 years, and when you have people like Zuckerberg, like Bezos, like Musk running the companies you own, just listen to what they're telling you. We don't have to be that smart. And if you extend it beyond the corporate sphere, so much of the information in the investment world comes out of such a small group of people, largely based in London and New York, who set the agenda for investors, who serve up to the monoplate the facts, the opinions. So actually just getting outside of that bubble can generate insights that that others aren't bothering to look for. Instead of looking at that investment bank piece of research, go speak to an interesting author on the topic. Find some of the leading academics and speak to them. And by the way, these people don't demand the sort of fees that the brokers will demand. So it's not about being more able. It's about thinking about what your source of information are and trying to set yourself up to be in a position to get access to the valuable ones.
Interesting. And a very good point about the concentration of the output is. And the other technical founder, so you've got Zuckerberg, you've got Jensen, of course, and I've forgotten the gentleman's name, but the founder of BYD, and you've just invested in BYD, and he's another technical supremo. Is that what made you invest in BYD, or is it just the obvious Chinese electric cars taking over the world?
I think that the way that people are looking at China is missing some of the bigger picture. So there's a lot of discussion about the weakness of domestic consumption, of the stimulation of the property market. I think that's a guessing game. What's going to happen with Trump's tariffs on China? Guessing game. The big picture is that they are moving incredibly quickly up the technology curve. And it's in electric vehicles, it's in semiconductors, advanced manufacturing, renewable energy, and it's actually that incredible progress which is giving rise to a lot of the geopolitical tension. But they stick with EVs. There's so many, there's such different cultures, such different places, but there are so many parallels between China and the US. A huge, domestic market, deep capital markets, focus on innovation and R&D, and great entrepreneurs who operate at real scale. So BYD operating in the largest auto market in the world, that auto in the domestic Chinese market, that market is moving much faster than elsewhere in the world. It's already more than 50% electric vehicles. The pace of innovation is much faster. The prices are much lower, and it's winning. It's growing top line 40%, yet making 20% plus returns on capital. And I think that sets BYD up in a position to be one of the global winners in EV. China it will have exported about 5 million passenger vehicles last year. That's up from 1 in 2020. And in 2020 it was a net importer. So the business have grown incredibly fast, made great returns. Volkswagen's profits shrank 40+% in the third quarter. The international, the established players are getting squeezed out, and I think that just grows out from China.
It's probably pretty bad news for Germany, isn't it? But there is an issue with China. I mean, the stock market has gone up a bit, but it's still pretty cheap. But there is this issue post-Russia that these countries are not investable. Now, I know you've got Meituan and all these unpronounceable stocks, but you're out of Baba, you're out of Tencent. Just talk us through your sort of the geopolitical environment and those stock selections. Why? Because Alibaba's still pretty cheap, right?
Yeah, I don't think geopolitical tension goes away. I think the friction only grows from here. I do think in the face of that, that maintaining those commercial links, those investment relationships, personal relationships, is an important part of what we can all do to stop that escalation. But our approach to investing in China has changed.
Mm-hmm.
If we're going to take China geopolitical risk, we have to be rewarded for it. We have to see a path to making many times our initial investment in those companies, and therefore we've sold out of some long-standing holdings like Alibaba, like Tencent, because they're starting from an already large size, because we think it's harder to meet that return threshold that's required in this geopolitical environment. And the common characteristic of a BYD or a Meituan, which you mentioned, or Pinduoduo, which is an e-commerce platform behind Temu, is that we think they can meet a higher return threshold that compensates us for taking that geopolitical risk.
And any observations on ByteDance and TikTok?
Well, you link it to the earlier conversation. You've got a technical founder, again, also linked to the AI thing, who spotted the potential of AI in the online media space years before other people did, and has been very successful at building that business. I think that there is this issue of what happens to ByteDance's business in the US, and I don't know. I mean, it's in the field of speculation at this point. It's unanalyzable. But I think the investment case for ByteDance does not turn on that. The US is a relatively small part of ByteDance's business. You can more than justify the valuation on its domestic Chinese business. And then there's what's going on in the rest of the world as well. But this is a business that on many metrics is a similar size to Meta. But is valued at a fraction of Meta. So for me, the risks and what happens in TikTok US is more than captured in the price.
It's funny because it's a private company, so you can't do anything. So even if you're worried about it, you can't sell it. Is that one of the sort of advantages of having a private portfolio?
It would be hard to say it's an outright advantage. I think one of the useful things for us is we've tried for years to act like long-term owners in public markets, and one of the positives of investing in a private company is you have no choice but to act as an owner. If the business encounters difficult times, you have to you have to be an engaged owner. You have to work with the team to try and address the problems, and that's that can be painful. As our experience in Northvolt last year showed. But one thing we found interesting is that it further improves our ability as public market investors to act like owners, because you've got no choice as a private company investor.
Were there any particular lessons from the Northvolt experience?
Well, I think it's much easier to get lessons from investments that go wrong than from investments that go right. I always think that you need to take your time actually working out what those lessons are. The danger of these things is that you rush to a conclusion. But I think there were a combination of challenges for Northvolt. It wasn't any one thing. It was a combination of challenges. But I guess that some of the things that I will think about more carefully when investing in a similar type of business in the future would be if your business model involves deploying a very substantial amount of other people's capital, then the dynamics are probably different if you're investing in, let's say, a capital light, social media business. The constraints on the founders and others necessarily are higher. The representation of those capital providers needs to be different.
Yeah.
I think probably another aspect is how does a management team deal with an almost open-ended opportunity? Because you've seen this huge demand for vehicle batteries in the past 5 years, and Northvolt have had opportunities in Europe, in several different countries in Europe, in North America, and I think one of the challenges that they've had is actually just how to focus on a small number of things and get them working really effectively. And it's difficult when you're sort of a child in the sweet shop.
When you make an investment in a private company, so I'm thinking of Jeff Bezos's one-way doors and two-way doors. You have to spend a lot more time in a one-way door if you can't reverse it. Is that the way you think about investing in a private company? Because once you're in, you're in. You can't get out. Whereas, if you change your mind in a public stock, you can just get out. So you spend a lot more time sort of evaluating.
I think there are some different aspects there. I'd say, first of all, the way I think about it with a company is, first and foremost, is it an attractive business? Mm-hmm. And then you can think about whether it's private or public. And in a way, let's just start with, is it an attractive opportunity? And worry about the other pieces later. The second thing would be to say, I don't think it is, a completely binary distinction between private and public. No. You can choose when in a company's life cycle you want to invest. And, you might invest in a growth funding round in a private company. You might invest in a pre-IPO raise. You might invest in the IPO. You might invest in the secondary market. There's probably a secondary placing. And actually, you can think about where in that piece you want to invest. And with a private company, the additional point is, yes, there's a funding round today. You can do it, yes or no. But maybe it is that you make a small investment. You learn about, do they deliver over the next 12 months, because inevitably there'll be another funding round coming, and you can actually build up those positions over time. But I think one of the things that you can't, one of the ways that it is binary is, if there is something, fraudulent, disreputable, anything like that goes on at that company, your name is associated with it, and you can't undo that.
No, sure.
So I think there is, it's probably on those issues that it's a one-way door.
Yeah.
And let's do an example, but I let's leave that. But
please don't do an example, because I don't want any more lawyers' letters.
But it's so I think that's it's those reputational pieces for which it's a one-way door. From an investment standpoint, I do think that there are lots of shades of grey.
Interesting. And you mentioned earlier the 73% drawdown in Nvidia, and I saw you'd sold Zalando, Zoom, Neo, all stocks who've had sort of tremendously volatile rise. I was just wondering, how do you keep calm with this? I mean, just having a long-term perspective can often actually lead you to the wrong conclusion.
And I mean, I just imagine it must be really, really difficult when you're seeing such volatility in share prices and understanding. Well, the question I really want to ask is, what will make you sell, and how do you distinguish between the 73% drawdown in Nvidia and the 73% drawdown in Zoom?
So I think that from an investment point of view, we've defined our task as delivering long run capital appreciation, and accepting that a consequence of that will be volatility.
Mm-hmm.
We've over delivered on the volatility
Mm-hmm.
in the past 3 or 5 years,
Mm-hmm.
and given our investors a wilder ride than we would have liked to have. And of course, we've made mistakes in that. I would say on the how do you endure volatility? I think it's about your mindset to the task. That as I turn up to work as an investor every day, and some of those days, some of those years are bad years, and some of those are good years, either from a absolute market performance or from a relative performance. And it's trying to, in so much as you can, dissociate yourself from that cycle, because you still have to come to work no matter which of those things is happening. And I remember sitting with Gary Robinson, who's the manager of Baillie Gifford US Growth Trust, and the co-manager with me on American Fund, and I can't remember when it was, but let's as a rough estimate, let's say it's 2017, and we'd had a really good run, and on relative performance, and we were sitting there one evening. I said, "How do you feel?" And he said, "I'm really uncomfortable. I don't like this. How do you feel?" And I was like, "Yeah, I don't like this either." But the point was that we weren't, we knew that things had been going our way and things had been going really well, and the emotion that elicited was discomfort, because you knew that after things have been going really well, they're going to go really badly.
Yeah.
And it does beg the question, of course, as a fund manager, when do you ever actually feel happy? Because you're definitely not enjoying it when you're underperforming it, and if you're not enjoying it when you're outperforming, that doesn't really leave much else to enjoy. But I think it speaks to the fact that you need, emotionally, you can't tie how you're feeling too closely to where you are in the performance cycle, because it's just so wearing. Now, it's inevitable that you, to some extent, you do, but as a mindset, I think that's really important.
Fascinating.
And then to your one about, well, how do you decide when to sell? There's not a formula. I think process is really important. So it's not emotion, because in these volatile stocks that would be really dangerous. But it's that cold evaluation of upside from here. First of all, do you really understand why you own the stock?
Yeah.
Do you have a clear, have you written down why you own the stock? I mean, forget the 12-page sophisticated note with lots of tables, but why do you really? What were the small number of things? What did you think was going to happen? So being clear about that in the first place, and then a cold evaluation of, right, this is off track, clearly, because it's not. Has it destroyed the thesis, or are the things that you believe, is it still possible that they're right? Have other people still there that you've backed? Do you and so I think it's sticking to process.
Yeah.
In those times when things aren't working for you, and having that discipline. And then final one on this, our bias, and again, you will have biases, so just try to know yourself in this. Our bias is that we hang on to things too long, because of exactly what you talked about. Because we've seen these drawdowns in our big winners, we're slow to sell a stock that's having a drawdown, because the amount of value that we would have destroyed if we sold Tesla every time it had one of those drawdowns. We bought Amazon in 2004. It had fallen by a third by 2006. That was when they introduced Prime free shipping. And suddenly all their most profitable, best customers became their biggest loss makers. The market hated it, shares sold off by a third. If we had panicked out at that point, it would have had a huge impact. If we'd it fell by half from 2008 to 2000 2000. I don't know where the trough was, probably the end of 2008, but it fell by half through the great financial crisis. And it's just an intrinsic characteristic. We've talked about Meta. That had fallen by half within about 2 months of the IPO when we bought it.
Yeah.
So it's knowing that you can destroy value. We have a bias to hanging on too long with these things, but we just try to stick to process.
Interesting. So I'm conscious of the time. You started a book club. So what are you reading? What would you recommend to people? And tell us about the book club. This is an interesting development.
Well, so book club, one of the things that's been important to Baillie Gifford's culture and approach is our geographic location, being in Edinburgh. I think we're away from the noise of London and New York. It is a facilitator of that slow investment process, if you like. If your advantage is patience, you need to be away from the action. And my observation in the COVID period, 2021, is that we were getting sucked into the action because geography was no longer important. If you were a company doing a roadshow, you could have a call with Fidelity in Boston, and then Capital in Los Angeles, and then Baillie Gifford in Edinburgh, and so we were getting drawn into the agenda, other people's agendas.
Yeah.
And so book club the idea was everybody in the American team, we're going to have a book once a month. Everybody's going to read the same book, and then we're going to sit down and talk about it. And in a way, it was symbolic because it was saying, reading books matters. Don't get too drawn into the world that we're finding ourselves in. And then there was a sort of selfish personal motive as well, in that when I read a book, you ask me a month later what was in it. I struggle to pull out more than a few key points. And so my thing was, well, if I have a group of people to sit down and chat about it with, it's going to crystallize a lot more of those thoughts in my own head. So there was a sort of slightly selfish motive there.
And has that worked? Has that?
Yes, that's. I mean, for me at least, it's and I think the other people in the team have we've read some books which I think have actually been really helpful in understanding what's. I'll pick an example. There's a book called "What's Our Problem" by I forget the name of it now, but if you're trying to understand what's been happening from a cultural perspective in the US and the divisive nature of this election, this woke backlash that you're seeing, go read "What's Our Problem," which was written 3 or 4 years ago, and I think captures a lot of it really well. You asked what I'm reading at the moment. It's a book called "The Master and His Emissary." And it is written by a physician looking at brain hemispheres. So the master is the right brain, and his emissary is the left brain. And it's just a really interesting look at how the different brain structures work, how they influence how we behave. And how that shaped the way that we've built society. Spoiler alert is that the left brain is getting over dominant at this point. I would it's not an investment book, but I do think books that help you understand how you think a bit better, sort of examine yourself and think on a sort of slightly deeper level about, well, actually, what are the thought processes that are leading to your conclusions, is really helpful. It's quite a dense read.
Oh dear, I've got such a large pile of books to read, and those sort of very challenging ones. When I think about what am I going to read next, I always think, oh God, that looks a bit formidable. So having the book club is a good way of forcing you to read the more challenging things. So that's something that people should copy.
I always listen to the more challenging ones. I find Audible as the solution to that one.
Listen to them.
Yeah. And that's a negative as well. So Gary, who I work with, is a big fan of Dee Hock, the founder of Visa. He wrote some really interesting stuff about chaotic business models. But I just can't read it because there's not an audio version.
Oh, really? I find this fascinating because when I wrote my book, they said, "Oh, will you do the narration?" And I thought, I couldn't even look at the final draft. And the final draft, they got the chapter headings wrong. I assumed that somebody else would check it, but no, the publisher was relying on me. So the first print run has got all the chapter headings wrong, and I couldn't bear the idea of reading it. So the way they do it is they ask you to listen to some editions, and the editions were all terrible. And there was one guy that was actually quite cheerful, so I thought, let's just have him. And the edition was quite cheerful, but the actual rendition was terrible. It was incredibly dull. So I must ask the publisher about whether I'm allowed to record it myself, because I think I could just about bear to
do it now.
to do it. Tom, it's been such a pleasure talking to you. Thank you so much for coming on.
Well, thank you very much for inviting me.
As I mentioned, I run training programs at Baillie Gifford for both some of their senior PMs and for the more junior members of the team. I have also done forensic accounting research for them. It's a really interesting and unusual organisation, and the culture has without question contributed to their success. Tom's comment that it was perfectly normal to see someone reading a book at their desk sums that up. And if I were to start out again, I think I would love to learn my craft at Baillie Gifford. Tom is incredibly down to earth in spite of mixing with the likes of Bezos and Musk. I love this comment. I meet investors all the time who are smarter than I am. And when he spoke about feeling uncomfortable when things are going really well, that also resonated with me. But my biggest takeaway was this idea that technical founders have a real advantage in an age of AI. I wasn't even aware that Zuckerberg had bought Nvidia chips at scale in the 22 downturn, which was clearly a great coup. I hope you enjoyed this episode half as much as I enjoyed recording it. We have some other really special guests lined up in the next few months, and I'm really excited about the podcast. Great news, Alpha Sense have agreed to continue to sponsor the show, and we've had record numbers of downloads. Please help us spread the word by subscribing to the show and by telling just one friend about it. Thank you for your support. Thank you for listening. I'm Steve Clapham. That was the Behind the Balance Sheet podcast. Please don't forget to subscribe to the YouTube channel. And why not visit our website, behindthebalancesheet.com, where you can find the show notes and lots of other videos which can help you on your investing journey. Thank you for watching.